The S&P 500 may be sliding today and over the past month, but guess what? Small cap stocks are doing even worse. How come? Let's find out with the Trading Nation team. Eddy Elfenbein edits the Crossing Wall Street blog. Ari Wald is a technical analyst with Oppenheimer. And over the past, month or so, Eddie, we've seen the Russell 2000 fall about 6%. The Dow down a scant 1.3%, so I'll call it a 4 times worse performance. To what do you attribute the weakness of the mighty mites?
I think there's just some nervousness heading into the election. But remember, if we back up, really since most of this year, small caps have been doing quite well, and within a pretty placid market over the past few months. About in late August, we saw over 400 stocks in the S&P 500 were above their 200-day moving average. That has gradually slid down. We've seen the leadership become narrower and narrower each week since then. Now it's less than 300 stocks, and that's what I think we're just seeing, a shift in risk assessment. And I think traders are particularly concerned about the Fed meeting tomorrow and also the election coming up. I think that's what we're watching.
Yeah, and you might have even understated it now, because we're getting to a point where almost historic lack of volatility. On January 1st, 2015, nearly 2 years ago, the Dow was at the exact number it's at right now. In other words, in almost 2 years, no movement. Let's focus still back onto the small cap stocks. Ari Wald, you look at the charts. It kind of looks like that Dow chart, kind of boring, kind of flat. Do you see any breakout anywhere for the Russell 2000 either way?
Well, what the underperformance by small caps is telling us, Brian, is that you want to own large cap stocks. And the chart I brought is a very big picture, long-term chart going back to the early 80s. It shows the relative relationship between the S&P 500 relative to the Russell 2000 overlaid with the S&P 500. And I think what you want to consider is that after 15 years of small cap outperformance, that's the falling line over the last 15 years, we are now seeing signs of a secular rotation, we think, into large cap stocks. But what that type of rotation is consistent with the secular bull market we saw in stocks in the 1980s and the 1990s. In fact, through the 18-year period from 1982 to the year 2000, the S&P averaged an annualized gain of 2.6% of outperformance versus the Russell 2000 through that up tape. So I think it's actually very consistent with the secular bull market thesis we've been talking about.
All right, there we go. Secular bull market thesis overall. Ari Wald, Eddie, thank you both very much. Reminder, folks, for more Trading Nation, you can go to our website at tradingnation.cnbc.com.
For an entry into an upside breakout, some traders use buy-stop limit orders placed above a resistance level. Unlike regular buy stop limits turn into limit orders to buy when triggered, not market orders. Thus, if a stock closes below the stop price one day and then opens far above the limit price, the trader will not buy the stock.
Hey CNBC fans, thanks for checking out our YouTube channel. Here you're going to find videos packed with all of the information that you need to be smarter about your finances. You can subscribe by clicking right here and click on all the videos around me or the eye right here to watch the latest from CNBC. Thanks for watching.